My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. I really enjoy this series. It's a way for me to interact with all of you. I know a lot of you have been commenting on the videos and saying, hey, you're really enjoying it as well. It's a great way for us to see how different people all across the globe are investing in this type of strategy. Before we dive into today's video, I want to take just a second and share a few thoughts on what's going on with GameStop. I think it is so interesting what we're seeing here in 2021. 2020 was a shit year. 2021 has turned into a meme year. I think it's just incredible. It's like, power to the people. I think it is so awesome that retail investors, your normal investors, you and I, that we're standing up against the big hedge fund managers on Wall Street. I think what's going on with GameStop is a great thing. I think it's unfortunate how some brokerages have handled this event. I think Webull and M1 Finance, they've done a great job in explaining that they were required or forced to halt trading that one day, but it was out of their control. Now, on the other hand, with Robinhood, how they handled this whole situation, I think they got a lot of people, a lot of their users really upset. And myself included, I think Robinhood has handled this whole process just completely terrible. And so for those of you that have been following the channel, back in 2019, I transferred from Robinhood to M1 Finance. And for all of you out there that are hating Robinhood or just disgusted by how they've handled this, I'll leave a link in the description below on how to transfer from Robinhood to M1 Finance. Really, really simple, very easy. I can recommend it. Having done it myself, I haven't looked back since. I'm really excited to continue following how this whole thing evolves with GameStop. With Wall Street Bets, I've been following it here for the last couple of days. I think last week I looked and there was around 2 million people that were part of this community. And fast forward to today, there's over 7 million people in this community. And a lot of people are calling this a movement, whatever you want to call it. I think it's so cool. I can only imagine that all the people here talking about, what's going on. As you can see here, this first post, never forget, right? Like a lot of people take this so serious. I can only imagine the conversations going on. They're probably a little bit like this.
I don't think we're asking the right question. I think the question we should be asking is, do you believe in this thing or not?
I do.
It's a problem you think we need to explain ourselves. Don't. To anyone.
Okay.
Now I'm gonna see this thing through for better or worse.
I love that. All right, so in today's video, we're going to take a look at 4 portfolios. The first portfolio is going to be from a 25-year-old here in the United States. The second, a 19-year-old in the United States. The third, a 21-year-old from Portugal. And then the fourth, a 49-year-old from the United States. And as always, everybody, I did not pre-script or pre-record what I'm going to say in these videos. I'm looking at the portfolios for the very first time. And as always, everybody, I'm not a financial advisor, so don't take what I'm saying as professional financial advice. It's just merely for your entertainment. I will leave timestamps in the description below, so if you're just interested in one or the other portfolios, you can check them out in the description below. The first portfolio here is from Nick. Nick writes, "Hi Jake, loving the content. You have helped me tremendously in identifying solid companies to invest in." Thanks, Nick. I appreciate the kind words. So your background here, you're 25 years old. Your goal here is to retire early with a mixture of capital growth and dividends. I contribute about $400 a month and just surpassed $50,000 invested. That is awesome, man. Congrats. $50,000 at 25, that's insane. Really interested in your take on how this portfolio is set up. I decided to forgo sector organization and instead focus entirely on assets with a yield and assets with a focus on capital growth. Okay, within each group, I simply put a slightly heavier allocation on what I see as the strongest companies and my favorite picks. As time goes on, I can easily adjust the allocation as I see fit. Keep doing what you're doing, Nick. Well, first off, Nick, this is absolutely incredible, man. You're 25 years old and you already have $50,000 invested and you're contributing $400 a month. This is incredible. Like, I mean, honestly, like you're one of the very few out there that will really reach this at 25 years old. This is incredible. All right, let's take a look at your portfolio. Your portfolio is up 134% over the last 5 years. This is not including the reinvestment of dividends. I love that you have it titled here, Freedom Fund. I view this as well as my freedom portfolio, right? Financial freedom. I love this. You have 54 holdings. Okay, that's a good amount. You just around 2% of your current dividend yield, and you have a small expense ratio. So you have some ETFs in here. You have it broken down, as you mentioned, not by sector, but by, growth versus income. All right, this is really great. Let's take a look at what you have for your dividend portfolio here, which is 60%. 91% is still a growth-oriented portfolio. This is really, really strong. You just have right under a 3%. Like if you're getting a 3% yield, current yield, with a 91% historical performance, this is really, really good. All right, so let's take a look. Your highest holding is the Schwab SCHD. This is a great ETF, by the way. Really, really good. I own in my portfolio as well. And then you have the rest here around 3, 2, and 4%. Okay, let's take a look and see what you got here. You got Realty Income. Okay, this is a really good REIT. You got JP Morgan, it's a good bank. BlackRock, also another good financial institution. Anthem, okay, good. Store, so looking at Store, you got 3 and you got 4. This is 7% into retail REITs. You're a little bit heavy on retail. Let's see what you have in the others. You got Toronto, so far we got some banks and we got REITs. You got another financial institution, you got Pepsi, you got Lockheed Martin. Lockheed Martin, for everybody out there, Lockheed Martin, in my opinion, is on sale right now. Lockheed Martin is currently yielding over a 3% starting yield. It's really trading at a discount right now, in my opinion. The next, you got NextEra Energy, really good. You got Merck, Home Depot, also really good. Johnson & Johnson, also another one that just pulled back here, Johnson & Johnson. Broadcom, DLR, okay, good. This is what I was looking for when we're looking at the REITs, that you're not just focusing on retail. So DLR, really good data center REIT. You got AbbVie, really, really good. Healthcare. IPR, okay. You got Waste Management, love it. Love seeing Waste Management in here. You got Verizon, so you went with Verizon instead of AT&T. I think that's fine. United Healthcare, okay, it's a good one. UPS has just exploded here since the pandemic. Same with Union Pacific. Both of these have gone crazy. Hershey's is also a really good one. I really like Hershey's. For all of those out there, international, Hershey's, the reason why I, as a U.S. national, invest or would prefer to invest into Hershey's is because of the international tax. Right now, it's around tax time. That's a big deal. If you were to invest into Nestle versus Hershey's, depending on which country you live in and the tax, I really like Hershey's. You got Qualcomm, you got Public Services, you got Prologis. Okay, this is a really, really good one. You got DLR and you got PLD. Prologis is a good one. This is a good industrial REIT, really good one. MasterCard, Costco, Comcast just raised their dividend. Really, really good raise, by the way. 3M also trading at a discount. Kind of, it's jumped up here a little bit, but 3M is also really, really good. I like 3M. Okay, you got AT&T in here as well. AT&T is good. You got Duke. Duke is one of my favorite utilities. American Waterworks, also another good utility, and American Tower. Okay, great. So you got a lot of exposure to retail REITs, but so you got retail, you got finance, you got a few industrials, you got a few consumers. You don't have a lot of technology. You got Broadcom, but you don't have a lot of technology. Depending on your time horizon, ones that you could maybe consider putting in there is maybe Apple. You could look at Texas Instruments. You can't go wrong with Microsoft. But if you were to add those, then you could put it down here at 1 or 2%, depending on your timeline. But as it stands, these companies, these are such great companies. I really, really like this portfolio. And not everybody is going to do it by sector. I like having it by sector because then I can, certain sectors traditionally have a higher starting yield, and it's a way for me to, my brain, how I allocate my portfolios based off of sector. You don't have to do that. And this is a good example of how you could do it without doing it that way. Now let's take a look at your other slice here, your growth slice. And you have 19 holdings in here. You have a half of a percentage of a dividend yield, higher expense ratio, and 253% performance. What do you got in here? You got ARK, ARKK. I really, really like ARK ETFs. You heard it here first. I really, really like ARK funds. I really like them. For those of you that have been following the channel, you know that I work in the technology sector, and technology is always changing. There's always disruption. And with the ARK funds, I think it is so interesting how Kathy Wood and her team are approaching this, the topic of innovation and disruption, and letting that lead their investing strategy. I think it's incredible. What else do you got here? You got VGT. VGT is also really, really good. VGT is probably my personal favorite growth ETF. You got Disney in here, great. You got Apple, this is where you have Apple. So my assumption is with this slice you would then transition from here into other assets or other things, right? With growth, you could then say, for example, all right, I'm going to invest into this for 10 years, and then I'm going to sell it at a gain and then buy a house, go on a vacation, buy dividend stocks, whatever it may be. So that's the perception that I'm taking here with this slice. Okay, so you got Amazon, you got Visa, you got Square, you got Tesla, you got PayPal, Nvidia. These are all really, really strong companies. You got AMD, you even got T-Mobile in here, you got Adobe, Facebook, Spotify, Shopify. Like, these are all really, really good companies. A few others that I really like, I like Roku, I like Zillow, some of those, this is a great growth portfolio. I really like that you don't have more than 5% allocated to one individual holding. I think that is very, very smart. I do the exact same thing myself when it comes to the overall allocation in my portfolio. It's a great way to protect your portfolio. And, if you're going to invest in individual stocks, you always do run that risk that, of the unknown. So I really like the fact that you're mixing in growth ETFs with individual stocks and you're limiting the allocation in your individual stocks. I think this is absolutely great. Thank you so much for sending over your portfolio. All right, the next portfolio here is from Erwin. Erwin writes, hey Jake, my name is Erwin and I'm here from Texas as well. I'm 19 years old and beginning of the year 2020, I have started my journey towards investing. After saving a couple $100, I've started using M1 Finance in March, and the app itself is just awesome. I agree. I love the app. My wife only uses the app. She doesn't use the desktop version of M1. At this moment, right now, I'm working a new job, recently a full-time restoration company, and working part-time as a blue home improvement store. And by then, I do hope in the coming weeks, as long as I manage to save a couple $100 again, I'll get started with a Roth IRA. Getting started in a Roth IRA at 19 years old is really great. You can let your money sit there for decades, and it can grow and compound tax-free. Really, really smart idea. You continue writing here. Right now, my portfolio is around $1,000, and where I'm currently at the moment, I can only invest around $200 a month. $200 at 19 is still really, really great, by the way. $200 at 19 is great. Plus withdrawing cash from my credit card and putting it to invest. Okay, so if I understand this correctly, you're using a cash advance on your credit card to invest. Okay, I'm not a financial advisor, but I would highly, highly encourage you reconsider that. The cash advance fees and the interest rates are so insane. If you do a cash advance, it's over 20% usually that you're paying on a daily basis, 20%. I would highly, if I'm understanding this correctly, highly encourage you to reconsider that. Me personally, I would never do that in a million years, personally. So far, the main objective here is to reach $5,000 to get a good financial head start. I think that's realistic. I think that could work. Your goal is to generate as much passive income as possible. You're looking to get into reach financial independence and retire early. I think that is a great goal, especially at 19. Man, I wish I started this goal when I was 19. This is awesome, man. So I think you're off to a really great start. $200 a month is a lot of money at 19 years old. Once again, with the credit card, if I understood you correctly, I do not recommend at all doing a cash advance and investing that in your portfolio. Never in a million years. So you got your two portfolios here. You got, it looks like a taxable portfolio and your Roth portfolio. Let's take a look at your first portfolio. Your first portfolio is up 160%. You got 10 holdings. You got a little expense ratio and just under a 1.5% dividend yield. So your taxable account, what do you got in here? You got the Vanguard S&P 500. That's great. You got the VEA. This is more of an international ETF. And you got the Vanguard Small Cap Fund. Okay, that can also work really well. Microsoft, especially for your time horizon. I think that's absolutely fine. Microsoft, Amazon, Apple. You got a corporate bond in here? You got some bonds in here. Okay. So you got bonds, you got real estate. I like that you have real estate holding at 5%. I like that. And you got emerging markets at 1%. Okay, so a few things with the bonds. You got 14% in treasury bonds. There's only two reasons you should ever have bonds at 19. The first is the emotional benefit. The second is if you're planning on timing the market and when the market goes down, selling out of the bonds and rebalancing into equities. It's the only two reasons. If those are not your reasons, I would highly encourage you to reconsider having bonds in your portfolio, especially in a taxable portfolio, right? Bonds and REITs, real estate investment trusts, are taxed at your capital, not your capital, but your ordinary income. So it's taxed higher than capital gains tax, right? At least under the current tax laws that we have today in the US. So those are a few things that I consider. I really like the ETFs. I like that you're focusing on like larger companies like Microsoft and Apple at your age. I like that you don't have so many holdings in here. I like that you're focusing on quality with VOO, VEA. I think this is absolutely fine. But definitely the thing that I would encourage you to reconsider are the bonds. I like that you have REITs at only at 5%. But yeah, that's what I would recommend there. Let's take a look at your Roth IRA portfolio here. You're up 54%, a little bit of an expense ratio, a higher dividend, and only 5 holdings. You got VNQ at 25%, VYM at 25%, GGRW at 18%, VOO and DGRO. Okay, so VNQ, 25%. I wouldn't have that more than 20%. 15, 20%. In all honesty, at 19 years old, man, you got like 40 years. You almost got 40 years of compounding ahead of you. I would encourage you to look at more of a growth-oriented allocation. I like DGRO. I like DGRW. The highest holding in this portfolio, in my opinion, should be DGRW, followed by VOO, DGRO, and then VNQ and VYM, simply because of your time horizon. I'd encourage you to take a look at some of my videos here that I've shared on time horizon, because the power of compounding, especially where it's tax-free, man, you have so much time for your portfolio to compound. And in my opinion, it's not just my opinion, it's just math. You're putting yourself a little bit of a disadvantage by going this route when you could. It's a lost opportunity. You could have so much more growth potential, especially in a tax-sheltered account like a Roth IRA. Now, if you were in your 40s or your 50s, I would say VYM, VNQ, 100%. This portfolio that you have structured here is more so for somebody that's in their late 40s or in their 50s. Being in your not even 20 years old, I would highly encourage you to reevaluate the allocation here. Thank you so much for sending over your portfolio. All right, let's take a look at the third portfolio. The third is here from Miguel. Miguel writes, "My name is Miguel. I'm 21 years old from Portugal. I started investing as soon as I turned 18, mainly with growth stocks, and I've gotten decent returns. Lately, I've been getting more into dividend growth investing. I'm contributing $200 monthly. I plan on raising the contribution as time goes by. My time horizon is 30 to 40 years. I plan to keep working, but I want the dividends to let me work on the things that I value the most." That is so great. That is exactly where my wife and I are at. This is amazing. I'm planning to sell some of my growth stocks and putting the money into a dividend growth portfolio. I will still have another portfolio, a smaller one, where I will keep some of the growth stocks I got at a really good price and I believe in, such as BYND and UPWK. Your channel has been really helpful in seeing the potential of dividend growth investing. Keep up the great work. This is a portfolio I had in mind. Any advice would be really helpful. Well, Miguel, thank you so much, first of all. I think it's so cool, man, that you started at 18 years old, right? I'm looking back when I was 18 years old. I wasn't investing when I was 18 years old, or definitely not like consistently, and didn't have a clear goal like you. And, you know, I've been to Portugal. I've been to the Algarve. I've been to Lisbon. Portugal is beautiful. I've even actually considered even retiring early in Portugal. Other channels like Our Rich Journey, you know, talk about their journey to retiring in Portugal early. I've looked into that a lot. Having, you know, with my wife being from Germany, you know, it's something that we are definitely considering. So let's take a look at your portfolio. So it looks like you have a small handful of stocks, which I think is a good thing. And you mentioned that you had those other holdings or smaller holding for a different purpose. But let's see what you got here. You got Microsoft, you got Apple, so you got some technology companies. You got Disney, you got AMCR. I'm trying to remember what AMCR is. I'm not, the ticker symbol is not ringing a bell. I know it's probably not AMC. Otherwise, you'd probably be pretty rich right now. Waste management, love it. You got 10% waste management. VHT is the Vanguard Healthcare Sector ETF. I know that. That's a really good one. Pepsi, I like Pepsi. I like Store. I like DLR. I like AMT, and I like O. Okay, so you got a lot in REITs. Let me see what you got here. You got Store. Where's Store? Store is, okay, 5%, DLR 5, AMT 5, and O. So you got 20% in REITs. Okay, that's actually not too bad. So you got 10% into retail REITs, and you got data center, and you got cell towers. Okay, this is good. I actually like the portfolio. I really like this. I'm not exactly sure what AMCR is. Can somebody do me a favor and type in the comments what AMCR is? I'm drawing a blank. I can't remember what that is. I really like waste management for your age. I really like Pepsi. I like that you have Pepsi in here instead of Coca-Cola for your time horizon. I personally own both, but I think that is really good. The fact that you have Microsoft and Apple at 15% is a little bit high. I personally like not having one company represent more than 5% of my overall portfolio. So you may want to consider adding maybe a technology ETF like VGT or QQQ to your portfolio, and then reducing your exposure to Microsoft and Apple. That's my opinion. And that way you're reducing your risk, right? So you got VHT in there, and maybe you could do, with Pepsi, maybe you could add, this is just my opinion, maybe you could add another consumer stock in here. I really like Procter & Gamble for your age group. So you would have Pepsi and Procter & Gamble. With Disney, you could maybe lower Disney a little bit, and you could either put you could add Comcast and Disney, or you could add McDonald's, for example. With waste management at 10, you could have waste management. You could have, I really like Lockheed Martin. I really like Caterpillar. There's others. But the main thing that I'm trying to share here is risk management, reducing your risk not only to your sectors, but also to your individual companies. Okay, so that's my opinion there. And but overall, I think the companies that you have in here are great. I love to see that you have such a concrete goal. I think you are off to an amazing start. And I'll be honest with you, Miguel, I'm so jealous. I wish I would have started with this level of sophistication when I was your age. Thank you again. All right, let's look at the last portfolio here is from Jay. Jay writes, Jake, I am 49 years old and a retired disabled veteran. I received military retirement, VA disability, and SSDI. I am changing my way of investing, and instead of having to research individual stocks, I redid my investments since last time and will probably adopt this approach. I looked at Vanguard Retirement Fund for my retirement age, so a target date fund, and then added 10 years so I can keep more stocks in it, and then went to M1 and did it myself so that I can save money on the expense ratio. So a 0.5 versus a 0.15 from Vanguard. This is really great. I'm sharing this as a get your perspective and also as an idea for others so that they can have an easy way to invest that covers pretty much all bases with not a lot of effort. My goal is to slowly build up money, but not have to worry constantly about rebalance and research of companies. Thank you. Jay, this is a really, really interesting way that you're doing this. And I shared a video a couple of weeks ago, or a couple of months ago actually, on exactly this topic around target date funds. And I love the fact that you're taking advantage of this and doing exactly this. It doesn't really require a lot of effort, right? And you can get the same performance as these target date funds by doing it yourself and just adjusting it maybe on a yearly basis, right? So for those of you that are maybe new or don't know what a target date fund is, target date funds are funds that are put together from the fund managers where it's based off of the desired retirement date, and they optimize the holdings in the fund or the index fund to match that goal based off of different criteria, risk management, performance management, all of that fun jazz. So you're 49 years old. So let's take a look at your portfolio. Your portfolio is up 68%. You have 4 holdings and you're just under a 2% dividend yield, and you have an expense ratio, a small expense ratio, as you mentioned. So let's take a look and see what you have in here. You have VTI, the total stock market ETF, at 54%. You have VXUS, the total international stock ETF, at 36%. I really like VXUS. That's the ETF that I hold in my Roth IRA because it is truly international because it excludes the United States. You got BND bonds, you got BNDX, so 10% allocated to bonds. You're 49 years old. I think it's absolutely fine to have 10% in bonds. Absolutely fine. One thing that I want to note here is, Jay, you mentioned that you're looking to invest in a dividend strategy. This strategy is going to be difficult to live off of the dividend simply because the allocation is so skewed towards the total US market and the international market, which is not really focused on a current income, a current dividend yield. This would be more of your traditional FIRE movement. The traditional FIRE movement talks about liquidating or selling off 4% of your overall portfolio over the lifetime, over your lifetime. And so with my strategy, I'm really talking about living off of the portfolio and living off of the dividends and not liquidating or selling my shares and thereby really creating generational wealth. So the approach that you're taking here, you have to understand, is a little bit different than what I'm talking about, but more so really what would be your standard FIRE movement, financial independence and retire early, where you're going to sell the shares with your time horizon. Okay. Now I'm not here to say that, that you should do that or you shouldn't do it. I think it's important you understand that is the difference. With VTI, with your time horizon, it's going to require so much more capital, so much more money invested to be able to live off of the dividend versus an SCHD or a VYM that's focused more on a current dividend. So now that you understand that, you can then kind of figure out, all right, well, what's important to you? What do you want to focus on? If you want to go the traditional FIRE route, and liquidate your shares, I think this approach can work very, very well. It's a very hands-off approach. It's not something that you're going to have to follow up on a daily basis. The thing that I like about this is it really is a set it and forget it. Okay, where you set it up once, you add to it, and it is something that you're going to reevaluate every year, every other year. It's not something that you're actively going to look at on a weekly, daily, monthly basis. So there's definitely pros and cons to this type of portfolio. But once again, the most important thing that you have to understand, unless you're pouring in thousands and thousands of dollars every month into this portfolio, it's going to be very difficult with your time horizon to live off of the dividend cash flow from this portfolio alone. So, and maybe that's not your goal, right? Maybe your goal is to be flexible, right? Where you have the bonds in here, you're going to live off of the bond, the dividends from the bonds, but with the growth, you're maybe then going to sell and do other things with that. So you're having flexibility with this approach. And I think it really comes ultimately down to your goal, and it could work very well. Or if you decide, okay, actually you want to optimize it in a different direction, you could do that as well. So the most important thing is understanding what is your goal and then optimizing your portfolio so that it meets your goal. And if you don't understand your goal or you don't fully know what your goal is, that's the first thing that I would encourage you to figure out is understand your goal, understand your time horizon, and then work, re-engineer or engineer your portfolio so that it meets your goal. Thank you so much for sending over your portfolio. Thank you so much, everybody, for watching the video. Thanks everybody that is new to the channel, that is subscribed to the channel. If you liked today's video, give me a thumbs up. If you are new to the channel, I'd invite you to subscribe, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.